also systematic and unsystematic risk in bonds. So if we look at bonds with regard to systematic and unsystematic risk, we think of bonds as being fairly safe, but there are risks involved. So let's look at systematic risk. Interest rates are definitely a systematic risk for bonds. The reason for this is, as you know from the bond lesson, that when interest rates go up, bond prices go down. So if interest rates move and you have to sell your bond before it matures, before you get the repayment of your investment, if you sell it early and interest rates have gone up, then the price of the bond will go down. In other words, you won't get all of your principal back. You won't get all of the money you loaned them back if you sell it early. That's a risk you can't avoid because interest rates move for all bonds together. So it's systematic risk that you can't avoid or diversify. In addition to that, there's reinvestment rate risk. This is tied into interest rate risk. Reinvestment risk is the risk that when your bond matures, that you won't be able to reinvest the money at the same rate of interest that you received before. In addition to that, your bond is paying you coupons or interest payments over time. So if you have a 10-year bond at 10% and you're receiving 10% per year from the bond, then you have to take that 10% to compound your money at 10%. You have to reinvest it at that same rate. Well, if interest rates move, your reinvestment is not going to be 10% any longer. So when you think of reinvestment risk, it's risk that interest rates have moved and you can no longer invest the bond coupons, the return on your bond, or the principal at the same rate that you used to have. So there's reinvestment rate risk based on interest rate moves that is systematic. You can't get rid of this risk by buying different bonds because when interest rates move, they move across all different types of bonds. There's also purchasing power risks. Purchasing power risk is basically inflation. Now, we've talked about inflation before. You should know that inflation is the costs of goods. Inflation is the cost of goods and services either going up or down. Inflation can move in either direction. And so prices change over time. So inflation or purchasing power risk is that in terms of bonds, is that you've invested your money at 5% and prices were going up at 3%, so you were making a 2% profit. However, or 2% real return, I should say. However, now as the bond matures over time, over say a 10-year period, prices are now going up at a rate of 10%. Well, if you're receiving 5% on your bond and prices are going up at 10%, your purchasing power is going down even though the amount of money you're seeing is going up. So there's a systematic risk of inflation changing and going higher while you hold the bond. So there are risks, systematic risks that can't be diversified in holding bonds. Now there's also unsystematic risk in bonds. Unsystematic risk is of course default. Now, this is similar to stocks. If a stock is a ship on an ocean and it capsizes and goes under, is a bankruptcy for the company. Default or credit risk in bonds is the same thing. It's the company or the bond defaulting and basically capsizing on the ocean, to continue the analogy. So there's a chance that any bond will default and not pay you back. Obviously, some are more credit worthy than others. But the way to diversify that, you can diversify that, is not to own just one bond, to own multiple bonds. So if you think of this in terms the same way you think of stocks, is if instead of owning one stock or two stocks, you own 30 stocks, then one stock falling would only cost you maybe 3% of your money. Same thing's true with bonds. If you own 30 different bonds, then you could only lose basically 3% of your money. Say 33 bonds, you only lose 33% of your money if one bond were to default. So default is an unsystematic risk that can be diversified down to a very low level, in other words, reduced. In addition to that, there's a liquidity risk. Liquidity risk is the liquidity is the ability to sell something or buy something very easily in the market. In other words, that liquidity for the major stocks, a Microsoft and Apple, a Coca-Cola, etc., is immediately liquid. Somebody will buy it. The price might be pennies different than what it was just a second ago, but it's liquid. You can immediately sell it. Well, individual bonds, there's so many of them. If you own an individual bond, it can sometimes be very difficult to get rid of it because you're selling an individual bond, and if you don't have very many of them, there's not very many buyers. So liquidity risk is unsystematic because somebody might not want to buy your individual bond. Overall, the bond market is very liquid, but individually one bond may or may not be very liquid, which of course would increase the required price to get somebody to buy it, which is, of course, decrease your profits. So unsystematic risk is the liquidity risk of your individual bond not being very popular in the market and not being able to move it very quickly if you had to sell it. Of course, if you hold the bond to maturity and the company doesn't default, then you would be able to receive your money back. Then you would still face all of the risks in your bonds under systematic risks. These are not diversifiable. These are diversifiable by holding multiple bonds. If you needed money and you had to sell a bond and one of them was less liquid than another, then you could simply sell one of the ones that was more liquid. If you had a default and you had 33 bonds in your portfolio, the most you could lose is that particular portion of your portfolio, or in round numbers, 3%. So think of unsystematic risk as diversifiable risk and systematic risk as non-diversifiable risk. Diversify the risks that you can and understand that there is no way to avoid some of these risks or all of these risks under systematic risk. So there's still risk in bonds. Even though they're safer than stocks, there's still risk in bonds, and it comes mainly from systematic risk over time. So think about that when you're discussing or dealing with bonds.